Welcome. Today, we delve into a critical component of financial analysis, the income statement. Many investors and even seasoned professionals make a crucial mistake. They focus almost exclusively on one number, net income, the famous bottom line. But what if I told you that this single metric can often be an illusion? That the true sustainable earnings power of a company lies elsewhere? In this presentation, we will challenge the conventional wisdom and uncover a more robust method for evaluating a company's profitability. We will shift our focus from the easily manipulated to the fundamentally defensible, revealing the engine that truly drives long-term value.
By the end of this session, you will be equipped with an advanced analytical framework. Our objectives are clear and actionable. First, you will learn to critically differentiate between accounting profit, represented by net income, and true economic profit, which is better reflected by gross profit. Second, we will introduce and define two proprietary metrics, the Gross Profit Stability Index, or GPSI, and the Unitary Gross Profit Trend, or UGPT. Third, you will be able to analyze case studies to see how these advanced metrics reveal the hidden strengths and weaknesses in different types of companies. Finally, you will understand how to implement the Gross Profit Anchor, a powerful investment filter to identify potentially undervalued, high-quality businesses. These skills will empower you to look beyond the headlines and assess the genuine operational health of any enterprise.
Let's deconstruct the illusion of profitability. Net income is susceptible to many distortions. It includes non-cash charges like depreciation, non-recurring items from one-off events, and the complexities of tax accounting. These can make the bottom line volatile and misleading. The real story is told by gross profit. It is the direct result of a company's core operations, revenue minus the cost of goods sold. It reflects pricing power, operational efficiency, and the strength of a company's competitive moat. To quantify this, we use the Gross Profit Stability Index, or GPSI. It measures the consistency of gross profit margins over a business cycle, typically 5 to 7 years. A higher GPSI, ideally above 1.5, indicates a predictable and durable business. It suggests the company can maintain its profitability even through economic turbulence. Next, we zoom in further with the Unitary Gross Profit Trend, or UGPT. Instead of looking at the total profit, we analyze the gross profit generated per unit of product sold, or per customer served. If this number is consistently increasing, it signals genuine operational leverage. The company is becoming more efficient and profitable with each sale. This combination of a high GPSI and a positive UGPT is a powerful indicator of a superior business, often before the broader market takes notice. Let's apply this framework. Consider a dull dividend aristocrat like Procter & Gamble. Its net income growth may seem slow and unexciting. However, its GPSI is remarkably high, reflecting incredible stability from its brand power. Its UGPT shows a consistent upward trend through premium products and cost-cutting. This is the hidden engine that powers its long-term growth. Now, contrast this with a sexy growth story, like a rapidly scaling software startup. It might show improving gross margins in percentage terms, but its UGPT could be declining. This would mean the cost to acquire and serve each new customer is rising unsustainably, a major red flag that the market, focused on revenue growth, might miss. Now, let's check our understanding. Take a moment to consider these questions. First, what does a high gross profit stability index primarily indicate? It indicates strong pricing power and a durable competitive advantage. Second, why is focusing solely on net income a potential mistake? Because it can be distorted by non-recurring and non-cash items, obscuring the company's core operational health. To summarize, we have established a new paradigm for financial analysis. The key takeaway is to use gross profit as your primary determinant of business quality and its competitive moat. Net income is merely the consequence, often swayed by transient forces. To put this into practice, use the Gross Profit Anchor filter. First, screen for companies with consistently high gross profit margins. Second, calculate the GPSI and prioritize those with a score above 1.5. Third, analyze the unitary growth profit trend for signs of true operational leverage. Only then should you examine net income. When you find a company with a high GPSI and strong UGPT, but its net income is temporarily depressed by identifiable non-core factors, you may have found a significant opportunity. The market fixates on the bottom line, but your superior understanding of the true earnings engine will allow you to identify generational compounders at a discount. Focus on the core, and you will uncover the value